Hello and welcome to this wonderful chapter, Financing of Working Capital. Working capital management has one more area, and that is how working capital is financed. In the earlier chapter we have seen receivable management, cash management, okay, payables management, but this chapter will tell you how this working capital is financed. From where will you raise funds to finance your working capital? Okay, so our next task is to find out how the finance manager is going to raise the funds for working capital purpose. We have already seen in the working capital management, the first chapter, that working capital requirement have to be divided into two categories, permanent and temporary. Permanent working capital always remains in the firm at any point of time, irrespective of season, whereas temporary working capital fluctuates, it varies with the season. So the financing should accordingly be decided. Permanent source or permanent working capital, it is also called core working capital, should be financed from long-term sources like debt and equity, because they are always going to be there in the business. But temporary working capital is required for a temporary period. Is it right? Yes, therefore, it is financed from short-term sources. Once your need is over, you can repay the loan. So that is one basic principle of working capital financing. Identify permanent portion, identify temporary portion. Permanent portion should be long-term sources, temporary or variable working capital should be financed from short-term sources. Working capital finance again can be classified into two categories. One is called spontaneous source and the other is called negotiable source. Spontaneous source means they automatically arise in the day-to-day operations. For example, trade creditors. Is it right? You purchase goods on trade credit. Then you have accrued expenses. Accrued expenses. What is accrued expense? Rent payable. You will pay after a month. So at least for 1 month you use that money. Salaries payable. Employees working from first day to the last day, but you are going to pay him on the 7th day of the month. So you are using employees' money in your business. If you are required to pay on daily basis, you will require funds for that purpose. Wages payable, telephone expenses payable, transporter bills payable, all these are spontaneous. They arise automatically. You don't have to separately enter into a contract. But then there are negotiable sources like bank loan. All bank related loan, you have to enter into a contract with the bank, sign a bank agreement, and then you get the funds, right? So spontaneous source means they naturally arise in the course of day-to-day operation. Example is written below. Trade credit, suppliers, credit from employees because you pay on after a month. Then again, credit from supplier of services. Negotiated sources means which are specifically negotiated with the lender, like commercial bank, financial institution, or even from general public. If you want to raise funds, you will have to negotiate. Next point is parameters guiding decision regarding selecting a particular source. When you become the finance manager after some years, you will need to raise funds for working capital. What factors you will keep in mind? First, you have to check the cost factor, which I know I have not written. One is cost factor. Cost of borrowing should not be too high. then you will not be able to generate profit for the company. If the interest rates are too high, all your EBIT will go in payment of interest, so earning after tax will be low or zero or negative. Second is, how does it affect your credit rating or credit worthiness? Too much borrowing can affect credit worthiness. Others will not give you loan if you are already into too much of debt. Then you have to analyze the feasibility of that. Reliability. Okay. Feasibility means, can this source be tapped by you? Is it possible to take the funds from this source? Then is that source reliable? Is that source? Because if there is no reliability, other party can ask money anytime, you will be in a soup, you will be in difficulty. Then what are the restrictions the other party can impose upon you? As we discussed in earlier chapters also, when you take a bank loan, they put restriction. Company cannot pay dividend, or company cannot pay dividend more than 10%. Company will not into mergers and acquisition. Company will submit the stock statement every month. Company will submit debtor statement every month. Company will have to submit quarterly P&L account, balance sheet to the bank every month. Promoter will also contribute 25% of the total cost or the funds required. Oh my God, whether these terms and conditions are feasible, and then you have to also ensure matching concept is followed or not. Short-term source, short-term needs. Long-term source, long-term needs. So therefore you have to also match the requirement with the source also. These are the factors which will influence your decision relating to source of finance. Now, for exam purpose, the question would be, what are the various spontaneous sources of finance? Spontaneous, which naturally arise in the business. You don't have to take too much efforts for this purpose. But they are very useful source of short-term finance, like trade credit. Okay, trade credit is a spontaneous source of finance. If you can purchase on credit, then it helps you to meet your liquidity requirement. You don't have to pay immediately. Okay, so depending upon the kind of business you are operating, you may get trade credit. Some businesses you may not get trade credit. In some companies, 1/3 of your total short-term requirement are met out of trade credit. But in some companies, not in every company. Everything that is written here can change from industry to industry, company to company. The dependence on the source is higher. Why? Due to less cost of finance as compared with other source. Generally, it is less expensive, but it can be expensive if the supplier charges you a higher price for a delayed payment. But why it is preferred? Because less formalities, less complications are involved. Only you have to make a phone call. Hello, Adani bhai, send goods. Then he will deliver goods to you. And you will say, then I'll pay after 3 months. Okay, deal done. Trade credit is guaranteed when a company acquires supplies, merchandise or material and does not pay immediately. So trade credit is only possible when you are not required to pay immediately. If the buyer is able to get credit without completing much formality, it is termed as open account trade credit. So what you will write in the exam, it is a spontaneous source of finance. It arises in the normal course of business. There is benefit of trade credit that it does not require negotiations, contract, paperwork, documentation, but sometimes there is a cost of trade credit, because if you delay the payment, you have to pay a higher price. Sometimes they may charge interest also if you delay beyond a certain date also. But still it is preferred, because like bank, they don't require too much of formalities to be completed. Another is bills payable. Have you heard bills payable? Bills payable you have studied in accountancy. In case of bills payable, the purchaser will have to give a written promise to pay the amount of bill or invoice either on demand or at fixed future date to the supplier or the bearer of the note. So what some suppliers do, they will draw a bill of exchange on the buyer. Bill of exchange. And then you have to sign that bill, accept it, which means you are promising that you are going to make the payment on or before a certain date. And those bill of exchange are transferable also. That means the supplier can sell it or transfer it to other parties also. But at least you will get the credit for 3 months or 6 months as mentioned in that bill of exchange. So it helps you to get short-term funding. And why it is preferred? Easy availability, simplicity. There is a bill, sign it, done. You'll have to pay after some time. Less costly. But if you go to a bank will charge you a high rate of interest. Okay? Bank will ask you to keep collateral with the bank. Small businessmen cannot provide collateral. And if you don't provide collateral, bank loan will not be available or at a very high rate of interest. So therefore, bills payable is useful for short-term financing. Third is very popular in business, accrued expense means expenses are paid after a certain time gap. It is again a spontaneous source of financing. Employee is working in the organization. He works on the first day of the month, second day of the month, and when do you make payment? Next month, 7th. So don't you think this money you are using for so many days? Actually the expense has accrued here, but payment is after so many days, 30 days, 35 days, 36 days. So for that period you are using the employees money. Or suppose you have to pay rent at the end of the month. So some companies pay rent on the 5th day of the next month. So are you not using the landlord's money for that period? Bills, electricity bill comes after 5 days from the end of the month. You have used the electricity for the whole month. So they are basically short-term sources of finance and usually there is no cost involved. Of course, if you delay then there may be some cost involved. It is automatic source of finance. Okay, there are no implicit or explicit costs associated with accrued expenses of the firm, and the firm can ensure liquidity by accruing these expenses. That is why many companies, what they do, they try to delay the expense payment as much as they can. First they will try to delay, like month is over on 31st of the month or 30th, but very few companies pay you salary on this date. Some company pay on 5th, 7th, and I have also seen some companies which pay on 11th. They are delaying. Electricity bill comes on 20th of the month and it is written in that bill last date of payment is 28th. So they will go and pay on 28th. Delay. When you have to pay, delay as much as you can, as long as you don't have to incur extra cost of delaying. Is it right? Now next is intercorporate loan and deposit. Intercorporate loan and deposit. Suppose one company, let us say Ambani Limited, and another company, give me some example. Adani Limited, okay, as you wish. This has surplus funds. They have shortage of funds. Very common in businesses. So why to keep shortage? Why to keep surplus and why to have shortage? So then this will give loan to the other company at market rate of interest. That is called intercorporate loans and deposits. Advantage to this company, they will generate income on that. Advantage to this company, they are able to raise the funds quickly without much formality. Understood? If you go to take a bank loan or a loan from a financial institution, then they will have a long procedure. Here this company will take an approval from the board. This company will take approval from the board and they will just transfer the money electronically. So within a day or two the funds are transferred and the interest rate is as per market rate. But again the interest rate depends on the financial soundness of the borrower company. If it is a good company, reputed company, high quality company, then the interest rate will be low. But if it is a doubtful company, risky company, risk of default is more, then the interest rate can be high also. So why do companies go for intercorporate loans and advances? Because it reduces dependency on bank financing. Next, tick, commercial paper, also called corporate papers, write down, also called corporate paper. In short, it is called CP, commercial paper or CP. Now first of all I need to tell you, it is nothing but a short-term instrument to raise finance, instrument for raising funds for a period up to 1 year, used by companies, okay. It is the name of the instrument used by the company to raise funds for a short duration, like 1 year. So commercial paper is an unsecured, no security to the lender. If company is bankrupt, your money can be lost. When you don't have any specific security, you have to stand in the queue. This normally does not happen. Only theoretically, if the company is not able to pay, then you are an unsecured creditor. You will be paid like an unsecured creditor. It's an unsecured promissory note, means the amount will be paid after a certain time period. That is called promissory note. Is it right? Issued by a firm to raise funds for a short period. In the exam, you can create 3 lines out of it. Which 3 lines you can create out of it? You will write it is an unsecured note. It is a promissory note. It is issued by the funds for a short period of time. Now short period means 1 year. Okay. Which companies usually issue commercial paper? Then this point you will write there that these are usually issued by highly rated corporate borrowers. What do you mean by highly rated corporate borrowers? That is whose credit rating is very high. Credit rating means the ability to repay the interest and principal amount of the loan. And there are credit rating companies in India who do the credit rating, like CRISIL, like ICRA, like CARE, CARE. So they give rating. Those rating symbols, those rating symbols tell you what is the risk involved. There are many companies for doing credit rating. You can check on the internet. I will give you name of 3 popular Indian credit rating company. Okay. So they will do the rating, then only you are allowed to do the borrowing. Because general public should know what is the risk involved. Is it right? Credit rating basically tells you risk involved in investing for short period of time and provides an additional financial instrument to investor with a freely negotiable interest rate. That means interest rate is not fixed. It is negotiable. The borrower and the lender can negotiate the rate of interest. What about the maturity period? This you will write in the exam. Maturity period is minimum 7 days and less than 1 year from the date of issue. And what about the minimum investment size? You want to invest in commercial paper? Yes, but minimum 5 lakh and then multiple of 5 lakh. Okay, 10, 15, 20, 25. So that is not for small investor, very small investor, because the risk is also high. They are unsecured instrument. Now next question is, what are the advantages and limitations of commercial paper? So advantage, why will company issue commercial paper? Already discussed, it is unsecured. So no security of the company is offered as collateral. So company's other assets are free from collateral. They can be used for other loan. Okay, and does not contain any restrictive condition also, because you are not taking a bank loan, you are raising funds from public. So there are less restrictions on commercial paper. Secondly, maturing commercial paper can be repaid by selling new commercial paper. Suppose you have issued for 1 year old, you issue new for another 1 year and use the money to repay the old one. That can be done if you wish to. Third benefit is, you can have a maturity period according to your requirement. Suppose you need funds for 6 months only. You can issue commercial paper for 6 months, and then commercial paper can be issued as a source of fund even when money market is tight. That means if you are not able to raise funds from other sources, you can raise funds from commercial paper. And the last is, generally the cost is lower compared to bank loan. Cost is lower compared to bank loan. You will ask why. I will tell you. Suppose this is Mr. A and this is the company XYZ Limited. Between the two there is a bank. So Mr. A deposits his money in bank. Bank pays him 7% interest. Then bank gives loan to XYZ at 12% interest. But then XYZ says, why I need to involve bank here? Directly they will approach investor and they will say, we will give you 9%. So A will benefit 2% because bank was giving 7. XYZ is giving 9. XYZ will benefit by 3%. Bank was lending to XYZ at 12. Now it is able to borrow at 9. This is just an example, but because you have eliminated the middleman, because middleman will charge his income also, because bank's role is to take deposit from people at a lower rate and lend it to corporate at a higher rate. Now you have eliminated the middle agency. So that is how cost of commercial paper to a company is usually lower than bank loan. Tailor to suit the requirement means, suppose you need funds for 6 months only, then you can issue commercial paper for 6 months. And point D is, a CP can be issued as a source of fund even when money market is tight, means when other sources are not available, bank loan is not available, okay, or any other source is not available, then companies can issue commercial paper. Now come to limitation. Not every company in India is allowed to issue commercial paper because these are unsecured instruments. Public money can be looted, cheated, pooled, okay, As it is in India, corporates, many corporates, without naming anybody, are trying to fool the public. And if you allow them to take unsecured loan from public, they might just take the money and go away or transfer to their other companies in Cayman Island. Oh, I will not tell you much about all this. Okay. So highly credit rating firms can use it. Those who have got high credit rating. Secondly, new and moderately rated firm cannot raise money through commercial paper. So in India only that blue chip companies they raise money through commercial paper. Blue chip means highly efficient, profit earning company, stable company, growth company. Okay. Another drawback is it cannot be redeemed before maturity. Commercial paper cannot be redeemed before maturity. It will be redeemed on maturity, nor can be extended beyond maturity. You have to redeem the old one on maturity and issue the new one. Yes, so some flexibility is not there. Now next, source of working capital financing. Our topic is working capital financing. Okay. Funds generated from operation. Best. Earn profit. Yes or no? And add back non-cash expense. Add back non-cash depreciation. This is the funds that you will generate from your day-to-day operation. In your cash flow statement, you call it cash flow from operations. And we have discussed one question also in some other chapter also. So that is called fund generated from operations. So only companies which have good profit can generate enough cash internally to meet your working capital requirements also. Okay. So that is called fund generated from operation. Fund generated from operation during an accounting period increases working capital by an equivalent amount. The two main components of fund generated from operations are profit and depreciation. So profit add back depreciation is the fund generated from operation. To the extent fund generated from operation, your working capital increases. Next is public deposit. Have you heard public deposit in your law subject? Public deposit. Companies are allowed to raise money from public by issuing public deposit which have a maturity of 3 years. And since it is 3 years, you can use it for short term to medium term only. You cannot use it for long term. Okay. So public deposits in India are governed by Companies Act. Companies have to comply with the regulation and then only they can raise money from public by issue of public deposit. That more about that you have in your corporate law. You can take some points from there and write it here, that what is the maximum rate of interest they can offer, whether they are renewable or not renewable, what is the purpose, working capital financing and medium term requirement. They are unsecured instrument. They are unsecured. So generally ordinary investor who don't understand business of a company should remain away from public deposit, because there are incidences where company is unable to repay and your hard-earned money will be lost. Bill discounting we have already discussed. In bill discounting what happens? The purchaser accepts a bill of exchange. Supplier goes to the bank, gets the bill discounted with the bank, so that it will be able to get funds for its working capital purpose. So bill discounting is also a form of short-term financing. If you don't have bill discounting, then you have to wait for 6 months, then the customer is going to make payment to you. So funds gets blocked. What you can do? You can get the bill discounted with the bank and raise the funds immediately. On maturity, the bank will collect the amount from the customer. But if the customer does not pay, then again the headache will come on you. Next is bill rediscounting scheme. Rediscounting. So discounting of a bill of exchange already discounted by a bank. So bank discounts your bill. Bank's money gets blocked. That bank can again get it rediscounted. That is called rediscounting scheme. It was introduced by RBI from 1st November 1970, long back, when your favorite Indira Gandhi was Prime Minister. Now Rahul Gandhi, okay, grandson, is working hard, is joining Bharat, okay. In order to extend the use of bill of exchange as an instrument for providing credit and the creation of a bill market in India with a facility for rediscounting of eligible bills by the bank. So one bank will get the bill rediscounted with another bank. So under this scheme, what happens? All licensed scheduled banks are eligible to offer bill of exchange to RBI for discount. So RBI says, don't worry, you discount the bill of exchange of your customer, we will discount your bill. This will give more liquidity to the banks. Otherwise, their money gets blocked. Homework for today. Factoring. Have you ever heard about factoring? In the receivable management chapter, factor provides services relating to receivable management. They collect money on the behalf of their client. They also give advance to their client. Client does not have to wait for the debtors to pay because they get advance against invoice from the factor. This way they can meet their working capital requirement. Okay. So in simple language, it is more like outsourcing function. Tick mark this paragraph below in your book, 5th number bullet point, difference between factoring and bill discounting. Question has been asked in the exam, underline. So two questions are usually asked from here. What is factoring? What is the difference between factoring and bill discounting? So let us learn this one. Factoring is also called invoice factoring. Factoring is also called invoice factoring, where a factor gives you advance against the invoice, whereas bill discounting is called invoice discounting. Second is, that was not a main difference, just name. Main difference is this: factoring, the parties are known as client, factor and debtor. The company is known as client. The one who is providing factoring services is called factor, and the customer is known as debtor. Customer is the party from whom the money has to be recovered. But in bill discounting, the person who draws the bill is called drawer. The person on whom the bill is drawn, who accepts the bill, drawee, and the bank is payee. Factoring is a sort of management of book debt. Factoring is more concerned with collection and management function of your debtor. Bill discounting is nothing but a form of short-term borrowing from a commercial bank. So in bill discounting, you have only financing element. But in factoring, it is not just financing, it involves management of receivable also, collection of receivable also. For factoring, there is no specific act. So which act applies? Contract Act applies. If it is a company, Companies Act will apply. If it is a listed company, SEBI guidelines will apply. But for banks, because there is a specific law called Negotiable Instrument Act. So bill discounting is covered by Negotiable Instrument Act. Have you heard about Negotiable Instrument Act?
Yes, sir.
Factoring. Next is working capital financing from the bank. Write down important. Working capital financing from banks. Banks are one of the major sources of working capital finance. First, you will try all other spontaneous source, other negotiated source. When nobody gives you funds, knock, knock, bank. So you have to knock the doors of bank only. And banks provide working capital finance. The purpose of the bank is to provide finance to a businessman so that he can carry out his day-to-day operations. Is it right? So banks in India constitute the major supplier of working capital credit to any business activity. Recently, any means illegal business activity, okay? You can't take loan for committing dacoity on highways because there also you will require working capital. You will require some gun, some car, petrol in the car, 3-4 helpers to carry out this noble activity. Is it right? Risk is there everywhere. They will not give you loan for that. But generally they give loan for any proper business activity. Some term lending financial institutions have also announced scheme for working capital financing. So even NBFCs are now providing funds. In fact, they are now just waiting for the customer to come. So much of competition has increased that instead of customer going and begging for loan, banks are begging now that please take the loan. We are willing to give you the loan. In your mobile also sometimes you get that message. Take credit card, take personal loan, take car loan, take education loan. Okay. Long back India was a developing country. That time banks did not have enough funds. Okay. In 1950s, 1960, 1970, 1980, 1990. So during this era, we were having shortage of funds. Okay, funds were not easily available. So that time there was lot of guideline on banks to give working capital finance. Because the idea was that the money should be used for capital expenditure, not for working capital. Working capital businessman should finance from his own pocket. We will give you funds so that you can create factories, infrastructure, machines, projects, right? So long back, maybe 1970s and 80s, government had formed two committees which were called Tandon Committee and Chore Committee, name of the economists who were appointed to give suggestions to the government and have evolved definite guidelines and parameters in working capital financing. Okay, so they had come out with a long list of recommendations. Our syllabus is only related to working capital recommendations, which have laid the foundation for development and innovation in the area. So government is also working hard to ensure that businessmen get funding, but at the same time they should not be over dependent on bank for working capital needs. So what instruction they have given this Tandon Committee and Chore Committee? You have to assess the working capital. Wait. Assessment of working capital. RBI has withdrawn the prescription in regard to assessment of working capital needs. Underline the word withdrawn. based on maximum permissible bank finance in April 1997. Now I'll tell you some background. As I've told you, India did not have enough funds in the first 5 decades after the independence. 1950s, 60s, 70s, 80s, and early part of 1990s, before the liberalization, privatization, globalization started in India. So government wanted to use the limited funds in the best possible manner. So there was a concept called MPBF, Maximum Permissible Bank Finance. This is the maximum loan the bank will give to you for working capital. There was a formula which is printed below. I am coming to that. But then 1997 RBI has scrapped that MPBF concept now. Now it is voluntary, not compulsory. Why it has removed this concept of MPBF? No, now the banks are free. Banks have more freedom to give loan. There are more funds. There, yes, it's not act. It is the guideline, because banks are now full of liquidity. Some of them have surplus funds. They are looking for customers to whom they can lend now. So banks are now free to evolve. With the approval of their board, board means board of directors, method for assessing the working capital requirement of the borrower with the prudential guideline and exposure norm prescribed. So now RBI has not given any formula. Banks can decide on their own how much working capital finance should be given, but they have to keep the overall guideline and norms which have been prescribed by RBI. So banks have to take into account RBI's instruction relating to directed credit. RBI has given a guideline on directed credit, which means specific sector, priority sectors. So while lending money, keep RBI guideline when it comes to priority sector. Example of priority sector is export, agriculture, okay, and prohibition of credit. They have also given guideline that you will not give credit to certain sector, like guideline is relating to bridge finance, rediscounting of bill earlier discounted by NBFC while formulating their lending policies. Sir, are we supposed to remember this? Good news. No. Okay, so you can skip this paragraph on the last day of the exam. Next page, maximum permissible bank finance, next page, wait. With the above liberalization, all the instruction relating to MPBF issued by RBI has been withdrawn. Our institute is our institute only. First they have mentioned so many things about MPBF, and now they are saying it has been withdrawn. It's unnecessary. Why you are keeping in the syllabus and confusing a pre-confused student? Is it right? But several guidelines have been issued which banks have to keep in mind. Now I will come to important paragraph number 10.29. Important. Why important? Asked in the exam. This entire paragraph is there in chapter called types of financing also. So you can mention here, also refer types of financing. Understood? So that you can answer. And as a good student, you should know different forms of bank credit. When you pass the exam and go to interview, some of the interviewers ask this basic question, and many students are not able to answer. What are the different forms of bank credit? Or how does a cash credit system work, or how does a bank overdraft work, or what is the difference between the cash credit and bank overdraft? Because when you go for audit in any business office, they use bank OD, they use cash credit facility, they use this letter of credit, etc. So you should know it, not just for your exam. But yes, maybe tomorrow when you will start your own office, you will need fund. So you can approach the bank and take the cash credit. What is cash credit? So bank will open an account in your name. Okay, open an account in the name of customer. This is how they will call it, ABC Limited Cash Credit Account, and then they will give you a limit, say 20 crores. Again, it depends on company, sometimes 50 lakh, 1 crore, which means you can utilize 20 crore rupees from this account. You can issue checks to your suppliers, employees from this account up to how much? 20 crore. If you have surplus cash, you can deposit in this account. Interest will be charged only on amount actually utilized. Limit is 20 crore, but suppose in the month of January, you only utilize 2 crore. So interest will be charged on 2 crore. Then you have surplus in February, you have only 20 lakh rupees balance, 20 lakh utilized. You deposited 1.80, interest on 20 lakh. So as the balance will fluctuate, your interest will be calculated on the outstanding balance. Okay. Borrower will not be allowed to exceed the limit sanctioned by the bank. If you are a good customer, later on bank will increase your limit. But first they will check how do you perform. Then another is overdraft facility. Suppose you have a current account. Now understand the difference. Here you have a current account. So normally what happens when you have a current account or a saving account, you cannot withdraw more than what you have kept in that account, right? But if you have overdraft facility, they allow you to withdraw more than the balance in your account. That suppose balance is 10,000 and you have withdrawn 20,000. So 10,000 is called bank overdraft. Is it right? Interest will be charged only on 10,000 rupees for the period for which it remains overdrawn. And suppose you have surplus money, you again deposit back into that account. They will stop charging you the interest. So it's a very good facility because sometime you may suddenly need money. Then again and again you can't negotiate with the bank. So companies keep OD facility in hand. That is, up to this limit they can utilize the overdraft facility. Okay. So it's a kind of short-term borrowing available to company in case of urgent needs. You don't have money. It is 6 o'clock in the evening. From where will you raise? If you have OD facility, you can immediately issue check of 20,000 even though the balance is 10,000. The bank will impose limit, of course. If the bank does not impose limit, then you will issue checks of 2,000 crore rupees. Okay. And then you will go to England and enjoy. When the borrowed funds are no longer required, they can be quickly and easily be repaid also. Very good facility. If you have surplus, again deposit. So you don't have to pay interest. Bank issues overdraft with the right to call them in the short notice. Or bank can ask you to deposit the amount in short notice also, but with good customers it does not happen. Bill discounting I have explained, so can I skip this? Bills acceptance, same thing. To obtain finance under this type of arrangement, a company draws a bill of exchange on a bank. The bank accepts the bill, thereby promising to pay out the amount of bill at some specified future date. Now, I don't think whether this bill of acceptance still works in India or not. Many of them are outdated now. But still it is in your syllabus, read it. Next point is line of credit. Earlier it used to be there. But I don't know how it operates now. That is, you can draw a bill of exchange and get money from the bank. It's like a short-term financing only. These are done to just give funding to the customers. Line of credit means it's a commitment by a bank to lend a certain amount of funds on demand, specifying the maximum amount. So what happens here? You will take a line of credit from the bank, let's say 200 crore rupees. It means whenever you need the funds, you will approach the bank and bank will make the funds available to you, so that you don't have to negotiate in the last minute. Is it right? So many companies, big companies, keep the line of credit ready, and if they need money, they can use it from the bank. If they don't need, it's okay. So if you need 50 crore only, take 50 crore. The purpose is that you don't have to pay interest on 200 crore. You have to pay interest only on what you will need. So bank will charge you some commission also for giving you line of credit. It's like a commitment that whenever you will come to me, I'll give you a fund up to a certain amount. But then I have to charge some commission from you. Okay. Now next is letter of credit. So this is basically used in export business. It's a sort of assurance by a bank. Okay. So this is suppose importer. This is exporter. Both are now fighting. Exporter is saying first you pay advance, then I'll dispatch the goods. Importer is saying first to dispatch the goods, then I'll pay you the amount. How will the deal be done? So importer goes to his bank. Bank issues a letter of credit in the name of exporter. It says that if the exporter dispatches goods to importer as per the terms and condition, with all the documents, with quality, whatever you have agreed, then bank will ensure that the importer will make payment to you. If the importer does not pay, bank will pay to the exporter. So it is kind of assurance, or what we call guarantee, given by the importer's bank to the exporter that my customer is going to pay to you if goods are delivered with all the terms and conditions which was agreed. If not, we will pay. Okay. And then similar is bank guarantee. For doing many tasks, you require bank guarantees. If you get suppose a contract, the contractee wants to be sure that you will be able to execute that contract. Okay. So therefore they will insist on a bank guarantee. You will go to the bank, you will take a bank guarantee, bank will charge you commission. It gives confidence to the other party that yes, we will be able to execute the contract, perform the contract. So it is one of the facilities commercial bank extend on behalf of their client in favor of third parties who will be the beneficiaries of the guarantees. Now we'll come to one outdated concept called MPBF, Maximum Permissible Bank Finance. In 1974, long back, almost 50 years back, RBI had formed a committee which was called Tandon Committee. The chairman was P.L. Tandon, and the purpose was to give recommendation to RBI as to how to improve the overall banking system. Okay. So I am going to explain briefly, you can read it later. Not very important. The only important part is they will ask you a numerical question that you have to solve properly. So Tandon Committee said, listen to me, company should not rely on bank for working capital financing too much. Working capital should be financed by the businessman from his own sources. Bank should gradually, slowly reduce their exposure to working capital financing. So they have given three methods of working capital financing, which are called method 1, method 2 and method 3, which means these are the formulae. According to this formula only the bank is supposed to provide funds for working capital requirement. So what are these three formulae? They are called lending norms. Now it is not mandatory. In 1997 this MPBF guideline has been scrapped. Now it is voluntary. But then why we are learning? We are the student. So they are called method 1, method 2 and method 3. Under first method, how much working capital finance the bank will provide? First, take total current asset minus current liabilities, you will get working capital gap. So this is the funds which the businessman need. Okay. So that time they said 25% will be financed from long-term sources. We will only give 75% of working capital gap. Is it right? So mathematically, can I write it like this? 75% of current asset minus current liability. So in the exam they give question, compute MPBF under method 1. One line answer, 75% of current asset minus current liability. Take current asset, take current liability. Second method is, first calculate current asset minus 25% of current asset. There is a difference between method 1 and method 2. 0.75% of current asset you will take, but current liability fully deducted. So that will give you MPBF. So here my formula will be 75% of current asset minus current liability. So MPBF under method 2 will be this. As you will go from method 1 to method 2, the MPBF will keep on reducing. The formula will give you lower and lower answer. And method 3 is even more conservative. It says first you calculate current asset. From that you deduct core current asset. Core current asset means what you have learned, permanent current asset. In the beginning we discussed today, which is always there in the firm. After that, you further deduct 25%. Then you deduct current liabilities. And now you will get MPBF. So MPBF here will be equal to 75% of current asset minus core current asset and minus current liabilities. Is it right? So this method will give you lowest answer. This method will give you, which method will give you highest answer? First method. And which method will give you lowest answer? So there Tandon committee said the bank should gradually move towards method 3. Bank should gradually move towards method 3 so that bank's financing of working capital will be reduced. And now in the note below they have written the same formula. Under method 1 it is 75% of current asset minus current liability. Under method 2 it is 75% of current asset minus 100% of current liability. And under method 3 it is 75% of the soft core current asset. Soft core current asset means current asset minus core current asset. Is it right? Minus current liabilities. Don't worry, very easy. And as mentioned above, again they are repeating, in 1997 the concept of MPBF was scrapped. Next page, at the top, concept of MPBF in 1997 is scrapped. Now they have come out with a new credit system. Underline, new credit system. In one exam they have asked this question, what are the salient features of new credit system? Have you found that in second line? Underline. This was a question in the exam. Anything they can ask you right here. These three bullet points you tick mark. So what is the new credit system now? It is very simple now compared to MPBF. They are saying you divide the borrowers into three categories. Underline. First, borrowers with requirement of up to 25 lakh. Underline, borrowers with requirement up to 25 lakh credit. They are small borrowers. So don't harass them too much, okay? Credit limit will be computed after detailed discussion with the borrower. That means you don't have to do too much of analysis. He's only asking for how much? 25 lakh. So call him, have a detailed discussion, and then decide whether to grant credit without going into detailed evaluation. Okay. Then if the requirement of the borrower is 25 lakh and up to 5 crore, then you can give him credit up to 20% of the projected gross sales. How much working capital fund can be provided? 20% of the projected gross sale when the requirement is somewhere between 25 lakh to 5 crore. But if the borrower is a big borrower, more than 5 crore, the third category is basically more than 5 crore. Now this is a big exposure for a bank. Am I right? 5 crore loss is a big loss for a bank. So here they are saying cash budget system will be used. So they will check how much funds the company would actually require by preparing cash budget. What will be inflows, outflows, shortfall, and accordingly identify the working capital needs. So these are the new system, new credit system. Okay. Now come below. What are core current assets? Core current asset means permanent component of current asset. Already discussed. Which are required throughout the year for a company to run its business. If you go to a woolen garment company, some stock will always be there. They will not shut down their shop and go for 6 months to some other place for enjoyment. Yes or no? Even if you go to an air conditioner company in the month of December or January, still there will be some stock. That is core current asset. Core current asset was concept given by Tandon committee. Okay. Their idea is that core current asset should be financed from long-term funds, also known as hardcore working capital. These assets are not liquid because they are always there in the business, and so companies are in need of money. They initially sell off non-core assets which are not important for continuous functioning of the business to raise money. So since they are permanent in nature, they are not liquidated by the company. They should be financed out of long-term sources. Example, raw material, WIP, finished goods, cash and bank are the example of core current assets. They will be liquidated only in emergency situation. Is it right? And what are non-core current assets? They can be liquidated if the company needs funds like natural resources, bonds, options and so on. Now good news. We will solve one example 1. Write down important. Example 1. And you will learn how to do the calculation. From the following data, calculate the MPBF under the 3 methods suggested by Tandon committee. Creditors, other current liabilities, bank borrowing, total. So these are 3 items of current liability. Under current asset, we have raw material, WIP, finished goods, other current asset, total asset. Below there is a note. Total core current asset is 200 lakh. Total core current asset is 200 lakh. So what are we supposed to do? Compute the MPBF under the three methods suggested by Tandon committee. Now, before we proceed, do not consider bank borrowing for calculation of MPBF. We want to know what we want to know. How much bank should finance? So how much bank should finance means I will take current liability excluding bank borrowing. I will take current liability excluding bank borrowing. Is it right? Because I want to know how much bank should finance the working capital requirement. So I will not consider this in calculation. So write down calculation of maximum permissible bank finance. Calculation of MPBF under three methods. As per Tandon committee norms. As per Tandon committee norms. So write down serial number, method, formula, calculation, and rupees in lakhs, last column. Okay, write nicely. Presentation is important. You can skip that serial number column. Just start with method 1. Serial number if you want to write. So, what is the full form of MPBF? Homework. Find out in the homework. So the formula is 75% of. One student is asking what is the full form of MPBF. Whole chapter is over and you are asking it now. Maximum permissible bank finance. It's written in the question also. Calculate the maximum permissible bank finance. So formula is 75% into bracket current asset minus current liabilities. So 75% I will take, current asset I will take 510, and current liabilities I am going to take only the first and the second one, 120 and 40, 160. I will not take that bank borrowing. My objective is to find out how much should be the bank borrowing. So that means I will take current liability other than bank borrowing. Final answer 262.50. Very good. One line blank. Point number B. Method number 2. Formula is 75% of current asset minus current liabilities. Very easy. Only you have to remember the formula. 75% into 510 I will take and minus 160. 222.5. 1 mark for this much effort. Can you believe that? Third formula, write down 75% in bracket current asset minus core current asset minus current liability. So 75% in bracket 510 minus core current asset 200 and minus 160. First you complete this bracket thing. 72.5. Now what is your observation here? Your observation is that as you will shift from method 1 to method 2, MPBF will reduce. Banks involvement will reduce, owners involvement will increase. Banks involvement will reduce, owners involvement will increase. What is the current bank borrowing? 250. And how much they can borrow? 262.5. So in first method, company still has 12.5 which it can borrow or the bank can lend. But in the other two method, the company has already borrowed more than the MTBF. Write a comment. Sometime in the exam they will be asking you to write comment. The company's existing borrowing, company's existing bank borrowing is rupees 12.50 lakhs. Not 12.50, sorry. 250. 250 lakhs. 250 lakhs. Company's existing bank borrowing is rupees 250 lakhs. Okay. Under method 1, it can still borrow rupees 12.50 lakhs. How did you get 12.50 lakhs? In bracket that is 262.5 minus 250. Okay. However, under method 2 and 3, under methods methods 2 and 3, it is not eligible for further bank borrowing. It is not eligible for further bank borrowing. Okay. We can see that, some more line write down, we can see that as we shift from method 1 to method 3, as we shift from method 1 to method 3, the bank's involvement in financing the working capital needs reduces and owner's involvement increases. And owner's involvement increases. And owner's involvement increases. Is it understandable? Is it understandable? Louder, louder.
Yes, sir.
Now at the end of this chapter, total core current asset is 200 lakh. That they have given. So don't apply your own intelligence. If they don't give, then method 3 answer will be same as method 2. Okay. But they will give you, they are asking you a question.
And for example, they have given the form of
That is only for example. Out of that only they have identified which one is core current asset. So I will request you, this is an outdated concept, don't spend our energy on that. Okay, since it is in the syllabus and you can see on the screen, it was asked for 5 marks in May 22 exam. Hence we are discussing it. Otherwise our institute should not have such questions only. Okay, because it is going to be useless in your future career. So question I will read from your book, same question they have just presented in a different format. Question number 1, you will find it towards the end of the chapter. Balance sheet of X Limited is given below. Equity retained earning 11% debenture public deposit short term. So that is current liability. Trade creditor, bills payable. So these are my current liabilities. Is it right? And you have asset side fixed asset, that is not current asset. But we have raw material, WIP, finished goods, debtors, cash and bank. Other remaining items are current asset items. Read the problem fully. Calculate the amount of MPBF under 3 method as per Tandon Committee lending norms. And again in the last line they have given core current assets are 30 lakh. So the 30 lakh includes some raw material, some WIP, some finished goods, some debtor. Okay. Some portion of that current asset will always be there in your form. Okay. So write down. First let us write down. First write down point number A, current asset. Current asset will be in this question total asset minus fixed asset. Do you agree? So total asset side is 980 minus fixed asset is how much? So what is the answer? And B, write down current liabilities. So here I will add the 3 items which are of current liabilities. Public deposit, short term is written, plus trade payable, plus bills payable. So tell me how much is that? 100 plus 80 plus 100, 280. Okay. Now write down calculation of MPBF. Calculation of MPBF. So first column write method. Then write down formula calculation and right hand side rupees in lakh. Understood? So first method 1 formula is 75% of current asset minus current liabilities. 75% of 480 minus 280. So how much is that? 150. One line blank. Method 2. 75% of current asset minus current liability. 25% of 480 minus 280. How much? 80. And method 3. 75% in bracket current asset minus core current asset and minus current liability. So we will have 75% of 480 minus 30. Is it 57.5 lakh? Same note copy. Note same as previous answer. In the exam don't write same as previous answer. Okay? Previous answer in the exam can be capital budgeting problem also. Debtors management also. So This was an exam question. Any corner of the book is possible in the exam. Okay, this chapter is over.